They say, cut your losses early. They say, never risk more than 1% per trade. They say, always protect your capital. You've heard this 1,000 times from trading books, YouTube mentors, and online coaches. It sounds like wisdom. It feels safe, and it gives you the illusion that you're being smart and disciplined. But what if I told you that those very lines, those seemingly harmless phrases, are the invisible chains keeping you stuck where you are? What if the entire philosophy of modern retail risk management is not designed to help you win, but to make sure you never rise beyond average? Because the truth is, markets don't reward safety. They reward understanding. Think about how trading education is structured. The first thing you're taught is not how to read liquidity, not how to identify smart money zones, not how to understand the psychology of big players. You're taught how to protect yourself. Don't lose too much. Stay small. Cut fast. In other words, the entire system conditions you to play defense, not offense. You are trained to think like prey, not like a predator. And when 90% of people in a market think that way, it's not hard to guess who ends up providing the liquidity for the real predators, the institutions, hedge funds, and algorithmic players who think in completely different dimensions. You see, institutional traders don't wake up worrying about how much they could lose on a single trade. They think in terms of exposure and information. Risk to them is not a line in the sand. It's a variable they can bend, stretch, and manage according to what the market is doing. Retail traders treat risk like a rule book. Institutions treat risk like a living organism. They feed it, measure it, control it, and sometimes even weaponize it. That's why when volatility spikes, retail traders panic, but institutions see opportunity, because they understand that risk expands where potential grows. Now think about the phrase, cut your losses early. On the surface, it makes perfect sense. Why let a bad trade bleed your account? But ask yourself, who benefits from this rule? Every time you set a tight stop right below the obvious swing low, who's waiting there? Every time you cut your losses early, who's collecting your liquidity? The market makers and algorithms that depend on predictable retail behavior. When you get stopped out, they get filled in. You think you're protecting your capital, but you're really donating it to the other side of the market. That's not discipline. That's conditioning. Let's paint a picture. You're watching EUR USD. You see a nice bullish structure forming. You enter the trade, and just like every tutorial you've ever watched, you place your stop a few pips below the last swing low. You feel safe. You've done it by the book. The market dips, hits your stop, you take a small loss, and then, as if mocking you, it reverses and flies in your original direction. You tell yourself it's bad luck, but it's not. It's design. The market needed your stop to fuel its move. You weren't unlucky. You were used. The real truth is, risk management as taught to retail traders is not about managing market risk. It's about managing your emotions. All these fixed percentage rules, tight stops, and one-size-fits-all formulas are there to keep you from panicking, not to help you think like a professional. Because real risk management doesn't live in your stop loss or your percentage. It lives in your context. It's about understanding where you are in the structure, who's trapped where liquidity lies, and what phase the market is in. You can't define risk as a number without first defining the situation. When big money plays, they don't just jump in and out of trades because of minor fluctuations. They expect drawdowns. They expect manipulation. They use volatility to their advantage. Retail traders, on the other hand, see a red candle and call it a crisis. Professionals see the same candle and call it information. Because to them, a stop out isn't failure, it's data. Every loss is a signal, showing where the market wasn't ready to move. And that data becomes fuel for the next, more informed entry. Let's go even deeper. You've probably heard the phrase, never risk more than 1 or 2% per trade. It's treated like gospel. But where did that number come from? Who decided it? It wasn't born from institutional strategy. It was created for retail consumption. A simple psychological rule that keeps people from blowing accounts. It's not wrong, but it's incomplete. Because 1% of what? In a high volatility market, 1% could be meaningless. In a low volatility one, it could be too aggressive. Context matters. Volatility matters. Structure matters. There's no such thing as a fixed safe zone in a living, breathing market. Institutions don't think in fixed percentages, they think in probabilities. They scale in and out, add to winners, hedge losers, and dynamically adjust exposure. They're not obsessing over how much can I lose on this trade. They're thinking, what's the asymmetric reward here? They risk 1 to make 5, or sometimes even 10. And when they lose on purpose, because every controlled loss moves them one step closer to the big asymmetric setup that pays for all the small ones combined. But retail traders are taught to fear losses so much that they never allow themselves to stay in a winning position long enough. They cut losses quickly, and they also cut winners quickly. The entire mindset becomes one of survival, not growth. And here's the bitter truth. If you keep playing not to lose, you'll never win. You'll just survive until your next mistake. The people who truly grow accounts understand that risk is not the enemy. It's the price of participation. The market itself is designed around the distribution of pain. Every major move begins by causing discomfort to the majority. Price sweeps one side, traps the herd, and then runs the other way. If you're trying to trade safely, you'll always be part of the herd that gets swept. There's no safety in the markets, only awareness. You can't hide from risk. You can only learn to dance with it. The traders who last long are not the ones who avoided pain. They're the ones who understood it. Let's talk about control. People love the word control in trading. They believe if they set perfect stop losses, fixed position sizes, and tight risk percentages, they'll have control. But the market doesn't respect your rules. It doesn't care about your plan. It moves where liquidity demands, not where your discipline dictates. The only control you truly have is over your reaction, not the outcome. That's why adaptability beats rigidity every single time. The market rewards those who can adjust their risk on the fly, not those who follow static textbook formulas. Real risk management is dynamic. It's fluid. It changes as the structure changes. It's about knowing when volatility is expanding and when it's contracting, when volume is real and when it's fake, when to hold size and when to reduce it. There are times when risking 5% makes sense because the setup is pure, clean, and high probability. And there are times when risking 0.5% is smart because the environment is uncertain. There is no universal rule. And that's the biggest lie ever told to retail traders. That trading success can be reduced to formulas and percentages. It can't. It's a living art. Let's go even further. Every market participant is part of a cycle. Institutions accumulate. Retail enters late. Institutions distribute. Retail gets trapped. The cycle repeats. And the main mechanism that drives this entire cycle is risk perception. If the crowd believes it's safe, that's when risk is highest. If the crowd is scared, that's when opportunity hides. The entire concept of traditional risk management feeds this loop. When retail traders are told to protect themselves, they cluster their exits. Those clusters become the perfect target zones for institutional accumulation. So ironically, your discipline becomes your downfall. You've probably experienced this. You follow your plan perfectly, every rule, every stop, every position size, and still lose. Meanwhile, someone with a messy strategy but strong understanding of liquidity wins big. You tell yourself it's unfair, but it's not unfair. It's asymmetric. The person who understands how risk flows in the market always has the advantage over the person who follows a rigid formula. The market rewards perception, not perfection. And here's something that most people can't accept. Sometimes the best trades are the ones that start red. The best trades often begin with discomfort because the market likes to fake weakness before showing strength, to lure in the wrong side before rewarding the right one. If your stop is too tight, you'll never experience that follow-through. Real traders understand that. They size their positions to endure drawdown because they understand structure. They know the difference between being wrong and being early. So what does real risk management mean? It's not about avoiding pain. It's about engineering your exposure so that when you lose information, not confidence. You lose small, not because a number said so, but because your read on the market changed. You win big, not because you got lucky, but because you built into the move intelligently. Risk management is not a set of rules. It's a living relationship with uncertainty. If you're still thinking in terms of safe trading, you've already lost the edge. There is no safety here, only understanding. You don't protect your capital by hiding from volatility. You protect it by learning how volatility works. You don't reduce risk by shrinking your position. You reduce it by improving your timing, your analysis, and your emotional discipline. Real safety comes from skill, not from fear. So the next time you hear someone say, cut your losses early, pause and ask, why? Who benefits when I exit too soon? Who profits from my fear? Who collects my liquidity? The answer is always the same. The people who understand the game better than you. And that's the entire point of this message. Stop being predictable. Stop playing the same game as everyone else. Start thinking like the ones who design it. The market doesn't punish those who take risk. It punishes those who misunderstand it. And once you truly grasp that, trading becomes less about fear and more about precision. You'll start to see that risk isn't your enemy. It's your greatest ally, if you know how to use it. If this changed the way you think about risk, then welcome to the other side of trading. Here at Profit Pulse, we don't recycle surface-level advice. We decode how institutional smart money really thinks. So if you want to understand how they manage liquidity, how they manipulate emotions, and how they use risk as a weapon instead of a weakness, go check out the other videos on this channel. And if you found this one eye-opening, hit the like button, subscribe, and drop a comment telling me what lie about risk management you used to believe. Because here, we don't follow the market. We understand it. This is Profit Pulse.